This past week, the US indexes slid with concerns that the Federal Reserve would begin to taper its monthly bond purchases before end of the year. The S&P 500 and Dow Jones suffered their second straight day of losses Wednesday, with the Dow falling more than 380 points to its worst performance in more than a month. Some people are worried that a correction of 10% or more might be coming, but the S&P 500 sits at 2% below all-time high, and the Dow is 2.5% below its all-time high. Still, both indexes are up roughly 17% and 14% on the year respectively through Wednesday's close. In this video, I will show you what to do when the markets crumble, so you make even more money. Hi there, welcome to your channel, The Foreigner in America, where I teach locals and foreigners everything related to money, personal finances, investing, real estate, and the markets. If you're someone like myself that loves money and wants to be independent and wealthier, please subscribe to this great channel and hit that bell so you're alerted every time I upload videos. I also post on Instagram and TikTok now at The Foreigner in America. I post on my blog, theforeignerin.america.com, where I elaborate more on the inside. And I have a new book called A Foreigner in America Can Succeed that talks about money, investing, jobs, dieting, exercise, friendship, among many other topics of interest, and you can get it for the cost of a latte in the link below. Volatility is troubling for investors, and experts caution people against selling when markets fall or trying to time a correction. When stock prices fall, it is a great opportunity for you to buy more stock at a discounted price. Volatility is normal and you got to embrace it. According to Brad Lineberger, president of Carlsbad Wealth Management, he says embrace the volatility because it's why investors are getting paid to own stocks. The real number that you should always be looking at is the number of stocks you own, not the price of the stock, which fluctuates when there is a market correction or crash. If you own 1,000 shares at $1,000 a piece, your portfolio will be worth $1 million. It is for any reason those shares drop 800 a piece, your portfolio is now worth 800K, but the number of shares is the same. You keep buying shares at a discounted price of 800 and increase your number of shares to, let's say, 1,200. By the time the market recovers, which can take 3, 6, or 12 months, those shares will go up in value to not $1,000, but probably $1,100 a share. This means that you not only have more money now, 1.32 million versus only 1 million, but you increase the number of shares. That's the real reasoning behind owning stock in the markets. If you're worried about a big drop and you're getting closer to age 65, then you should rotate part of your portfolio into some less risky stock to protect it from a correction. I'm telling you, when stocks are at a discounted price, it's like real estate in a discount. It's the best opportunity for you to buy, not to sell. Only sell to redistribute your portfolio or to buy another thing that will make you more money. Had you sold in the best 20 days in the S&P 500 over the last 20 years, your average annual return will shrink to 0.1% instead of the 6% that you had earned had you stayed in the course. Managing the risk is a really important part, said Leila Morgillo, a CFP with Madison Financial Planning Group in Syracuse, New York, which oversees about 200 million in assets. It's not about trying to shoot for the highest rate of return you can. It's about protecting what you have. This is where having a plan is important. If you have a plan and you follow it through good and bad times, it's very difficult to get off course. If you're only investing without any plan, it will be easy to get emotional and start selling when things get ugly. The most important thing for any person investing in the markets or real estate is to have an emergency fund. I cannot say it enough. My previous video on how American families cannot cover a $2,000 emergency is just sad, because it means that they do not have emergency funds and they live paycheck to paycheck. If something happens, they have to tap into the credit cards and get worse financially, or they need to tap into their investments and go back in their plan many years. During the March 2020 meltdown, you only needed around 6 months of living expenses in your emergency fund to go over it and keep living life as usual, talking about the markets. If you lost your job, you could have claimed unemployment and used that as your emergency fund without actually touching that fund. Now let me give you my foreigner insight for this topic. Investors understand that bulls make money and bears make money, but pigs get slaughtered. Unfortunately, the market is a transfer of money from one pocket to another. Every time you make money, someone else lost it. It's not like real estate where everyone can make money without another person getting affected. Having a 6-month emergency fund in your bank account will ensure that you don't sell any of your assets, and it will also ensure that you can cover any kind of emergency that might present itself. Have it always on hand. Keep buying stocks, keep buying real estate, and never sell unless you want to transfer the money into something safer or into something that will make you rich. Make sure you give me a like if you enjoyed this video, subscribe to my channel, and hit that bell so you don't miss any one of my 2 weekly videos. Check out my Instagram, my blog, and the TikTok, and make sure you also check out my new book, A Foreigner in America Can Succeed, which is a solid read. You will love it, and you can get it on the link below for the price of a latte. Thanks a lot, and I'll see you next time.